Fire Pension Board on Tuesday, October 22nd, 2024, and I will read the land acknowledgement. The City of Albany recognizes that we occupy the land originally protected by the Confederated Villages of Lashon. We acknowledge the genocide that took place on these lands and must make strides to repay the moral debt that is owed to this indigenous people, specifically the Ohlone tribe. We thank them for their contributions, which have transformed our community and will continue to bring forth growth and unity. The City of Albany commits to sustaining ongoing relationships with the tribe and together build a better future for all that now make this their home. City Clerk, can we please call the roll?
Yes. Member Alternate Tiedemann.
Here.
Member Schwartz.
Here.
And I'm here, and representative or members from Police and Fire Department are absent.
Thank you. I believe that means we have quorum. We'll now move to our consent calendar. Are there any members of the board who would like to pull an item for separate discussion or take it off consent? Seeing none. Any members of public? Not seeing any in the room. I don't believe we have anyone online. Then I will look for a motion on consent.
Recommend approval of the consent, motion to approve the consent calendar.
I'll second. Means we have a motion and second. City Clerk, please call the roll there.
Member Alternate Tiedemann.
Yes.
Member Schwartz.
Yes.
And I vote yes. So the motion passes.
Excellent. That moves us to public comment. It's for persons wanting to address the board an item that is not on the agenda. Again, seeing none in the room. I don't believe we have any online. We'll move past that to announcements. I do not believe we have any announcements unless I'm told differently. So we will move to our reports, which I will toss it over to Dewey.
Pull it up to share.
So this is the quarterly review of the third quarter of the pension portfolio that we advise on. If you could go to the next page. Next page, please. So this is the current asset allocation at the end of September, so at the end of the last quarter. Currently, the portfolio has about 3% in cash, $59,000, $968,000 in fixed income in bonds, 43%, and 55% in stocks, so $1.23 million. Total balance at the end of the quarter was $2.258 million. Next page, please. This is the change in market value over the last quarter. So we started the quarter at $2.43 million. $300,000 was withdrawn, transferred to the operating account. The income received, which is interest and dividend over the last quarter, $14,800. And capital appreciation, the change in price in the investment, $113,000. So total return was the sum of income and capital appreciation, $127,800. That translates into the balance at the end of the quarter. This is the change in market value since inception. So we started managing this portfolio or advise on this portfolio exactly 15 years ago, September or the third quarter of 2009. So started in 2009, close to $11 million. Over the last 15 years, $15.4 million was withdrawn. The income received $2.4 million, capital appreciation 4.3, so translate into a total return of $6.77 million, and that with the withdrawal, that translates to the current market value of the account. The next page is the performance over the last quarter, last 3 years, and over the last 15 years. So year to date, the last 3 quarters, the portfolio returned 11%. Last 3 years, 5.2%, and since inception, so since 2009, 7.35%. If you notice the last 3 years, 5.2%, this is including the sell-off in 2020, in 2022. Right around this time in 2021, exactly 3 years ago, the stock market set all-time high, and going into 2022, we had a significant sell-off. But overall, if you average out the return over the last 3 years, the portfolio still generate over 5%, which is more than the actuary expectation for a balanced portfolio in the same period. So for this year, year to date, if you looked at just the return on the fixed income and on the equity, everything was up, basically. So fixed income, that was the result of 2022, the Fed raising interest rate to over 5.5%, and 2023 was more of a period where bonds prices readjusted. And for the whole year this year, it's a lot of it was interest rate movement and the expectation that the Fed would start cutting rate. So that translate into the performance of the bond funds, because as rates come down, prices or the return on these bonds go up, and that translate into kind of the bull market. They call it bull market of everything. On the equity side, just one note on the equity. If you take a look at the equity over the last 3 years, this is the Dodge & Cox stock funds is the fund that has been in the portfolio since inception, since we started advising on the pension. This fund has been very well protected on the downside. So if you look at over the last 3 years period, that the first year of the last 3 years, 2022, the fund has done tremendously well comparing to the overall market. And on this year and last year, the fund continued to perform well. So that translates into double-digit return considering what we've been through. So in this report, I included a couple more pages that we haven't had before. This is just a last 12 months account flow at the bottom here for reference. So that translates, so exactly this time last year, the pension account was about $2.1 million. So all year, including the withdrawal of $300,000, the portfolio actually went up, and that translates into about 19% return at the bottom. If you go to the next page, this is the return over the last 5 years at the bottom, total return over the last 5 years for the pension account. I talked a little bit about 2022. If you looked at the 2022 return, it was down, but significantly less comparing to the overall market. The bond market was down high single digit, and the stock market was down close to 20%. But on average, the pension portfolio was down just under 9%. And that's, if you look at 2023 and so far year to date, that's kind of made up for the loss in 2022 and then some. This is just the current holdings of the pension account. So they're about $58,000 in cash. $40,000 of that is sitting in high yield money market. In bonds, there are 2 bond funds: the short-term Vanguard short-term bond fund and the Dodge & Cox income fund. We added the Vanguard short-term bond in 2022. Because the approved investment in the portfolio was just a Dodge & Cox fund and the equity fund and the income fund. In 2022, we saw that bond funds on the Dodge & Cox was more longer-term bonds that was affected by the rise in interest rate. So we wanted to balance out with a more short-term kind of bonds, and that was the reason. And we went with Vanguard because of the low fee for the pension. So that's balanced out the duration of the bonds in the portfolio. The equity in the portfolio remains the same. And moving on to market outlook. So to a look back of the market so far this year. So just year to date, if you look at the U.S. stock, this is the S&P 500 year to date into the end of September. The S&P was up 22%. International was up 13%, and emerging markets up close to 17%. On the bond side, long-term bond treasuries was 2.4%, intermediate bonds 4.7%. That was corporate bonds, and then corporate high yield is about 8%. So if you look at the return of the bond funds in the portfolio, both of the funds did extremely well versus the overall bond market. We don't have any equity commodity in the portfolio, but something to note is it's the rally in gold over the last year, up 27%. Gold's been kind of the commodity that investors are moving toward just for inflation protection over the last few years, and it kind of accumulated over the last year. As a hedge for inflation. We don't have a view on gold, but it's just interesting to note that over the last 15 years, this is the period where gold actually performed and outperformed stock. Investment themes, I'm just going to go quickly. Over the last quarter, the theme or the main theme was the Federal Reserve cutting rates. Toward the end of September, the Fed cut 0.5% rate. And going into this year, 2024, the market had anticipated that the Fed would start cutting rates sooner. At the beginning of the year, the market projected that the Fed would start cutting rate sometime in the summer, beginning of the summer, and there would be 4 rate cuts. But what happened was the economy showed more resilience, and inflation was more sticky than what the Fed and the market anticipated. So in September, when inflation came down to about 5.5%, that was when the Fed was comfortable cutting rates. But it shows the resilience of the economy. We expected the economy to slow down. The Fed wanted the economy to slow down, but it did for a little bit, but it wasn't, the key thing is that the economy is not heading into a recession. Exactly the same time last year when we talked, even our firm, we anticipated that we would have a mild recession sometime this year. It didn't happen, and the economy proved to be more resilient than most of us anticipated. And that translates into the return in the market overall and the delay in the Fed cutting rates. But looking ahead for this quarter and into next year, the overall economy continued to show signs of strength, even though economy slowed down. Unemployment picked up a little bit, over 4%, but it's not in an alarming level. It's the level that the Fed wanted it to happen for them to fight inflation. And new jobs continue to show up, so that translates into a pretty good economy overall. And we expect we don't anticipate a recession now. In the market, we're anticipating a soft landing, just mean that economy slow down, but we don't hit a recession, and it would start growing back up again. Next page, please. So I talked a little bit in terms of soft landing insight. The key thing that this is more the Fed, kind of the scenario that the Fed wanted it to happen from the beginning of fighting inflation, that they raise interest rate and monitor it so that the economy slow down, inflation come back down, but they don't want to put the U.S. economy in a recession and cause a bunch of layoffs and job loss. We are looking at a very kind of mild scenario where the economy slow down, but it's back to a level where the Fed is comfortable with economic growth, and we're not anywhere near signs of a recession. Next page, please. I'm going to skip this page. Housing. So, U.S. equity. So, what kind of relevant to the portfolio of the pension is the return of equity going forward. Right now, if we look at the valuation of stock, most of the portfolio in stock in the pension is U.S. large cap. U.S. large cap valuation is relatively expensive comparing to historical numbers, but it's not outrageously expensive like in 2007 or in 2019 going into COVID. So where we are right now, comparing to historical averages, we're a little bit expensive, but we do believe that earnings growth can continue to outperform, and the U.S. large cap companies can grow into this valuation. So based on the growth of earnings, we feel comfortable where we are and maintain a little bit overweight of U.S. large cap. The positive sign over the last quarter was going into this year, the market, the S&P 500, which is like the indicator for U.S. large cap, was very concentrated in the 7 or 10 names, largest companies in the S&P. Most of them you can see on the charts. At the end of the year, last year and early this year, 62 to 52% of the earnings was concentrated in the top largest companies. The last quarter, profits is broadening out. So other part of the large cap, the S&P continued to perform, and we do. That's a good sign, and we do believe as it's broadened out, that's a good indicator for U.S. large cap to continue to perform. And that's pretty much it for my presentation. The rest, it's just, we don't have any international investment, we don't have China, and we don't have private equity in the portfolio. So, any questions, concern? So, just a quick question to plan for cash, because I don't plan on rebalancing the portfolio. Like I said, the portfolio is managed with a balanced approach, 50-50, 50% bonds, 50% equity. We believe right now we can say a little bit overweight on equity, but just wanted to make sure in terms of cash requirement for from now to the end of the year, do you anticipate any withdrawal or the normal $300,000 withdrawal?
I don't anticipate anything extraordinary. We have, as you can see in the reports, about $80,000 a month in pension payments going out. I believe we have sufficient. I think we're at about $300,000 in the cash account at Mechanics. So we easily can get to the end of the year, and then we'll need to move money again toward the end of the year, but nothing extraordinary.
Okay. Then we'll just maintain the same level of asset allocation for now. All right, that's all I have for today. Thank you so much.
Thank you very much.
Thank you.
I'm assuming we still have no one online. Then we will move forward. Thank you for that report, and go to our discussion and possible action, which is on annual payment update for board's approval.
I would be delighted to speak to that. Just as a note, anytime we have a change, for example, the Albany Police Officers Association just ratified a new contract that is in place starting at the end of October, and our disability retirees have their amounts recalculated when there are changes in that active police contract. And so there are 3 folks who have adjustments to their pension checks as a result of those percentage changes. So it's partially implemented in October, just the trailing week, and then fully in place starting in November. So we will be sending those folks that notification, assuming it's approved by the board, so that we can keep up with the required changes in those pension calculations. And I'd be happy to answer any questions.
Thank you. Seeing no questions, do we need a motion for approval on this? I will move approval.
Second.
Motion and a second. Please call the roll.
Member Altona Tiedemann,
Yes.
Member Schwartz,
Yes.
and I vote yes. So the motion passes.
Great. That will bring us to future agenda items. Do any of us have any future agenda items?
I do not.
Seeing none, that will bring us to our next meeting. Our next meeting will be on January 28th, 2025 at 3 o'clock. And with that, that brings us to adjournment. Thank you all for being here.
Thank you, Chair.